we are marching, we are there on moon now, and M stands for merger and acquisitions as well. We also seen that globally so many merger and acquisitions are happening. In USA only more than 20,000 merger and acquisitions are happening in a year. We have a statistics of India till July, I guess only 1400 or somewhat merger and acquisitions happened. So it's a immense opportunity for all of us to enter in this forte as well. Since litigation practice or a compliance practice is being going to reduce in the future, we need to have our footstep so far as the startup valuation and IBC is concerned, and we have learned, young and visionary faculty here today, none other than CA Karan Vora, who is heading investment banking firm Vora Corporate Finance and has rich experience in merger and acquisitions and fundraising. He has been banker and advisor in number of large corporate M&A deals like Atlas Life Sciences, acquisition by Asahi, internal structuring of Rubber King tires, and lot many. He has earlier worked with the Kotak Corporate Banking, Gujarat, and Indian Oil Corporation, Mumbai. Mr. Vora, CA Vora, is regularly invited as guest faculty at ICAI, CA Association, MBA, Nirma University, MBA, SBS, etc. to share his insights, and his articles on capital markets are published every month in Journal of CA Association, Journal of ACAE, Kolkata, and on ISB Alumni Network. Yes, he is a registered valuer and alumni of ISB Hyderabad. Please give big round of applause to Karan Bhai, and we welcome you.
Thank you. So first of all, I would like to thank Anjali Choksi and Abhinav Malavia, and we have and Sunil Sanghvi. And we have today, I'm lucky to have Darshan Bhai, senior CAs like Darshan Bhai sitting in the audience, then Bishan Bhai is there. So we just heard Hiranand Savlani. I think, he has summed up a lot of things very nicely. We'll just be going slightly in detail in a lot of things which he has said. And I was very happy that he has covered almost the buy side of M&As. Astral is a serial acquirer now, we can say. They have already done 6 acquisitions. And he has very nicely explained that as a buyer, what should you consider. So now he started his lecture, a lot of things he said right. So first thing he started was the India story. So no one can doubt India story. Yeah, yesterday, India is on the moon, and that's how the lecture started. So India story is true. If you see globally, which markets are performing very well. So US market has always been the best market, but it is saturated. Okay. Now any MNCs globally, if they want to grow, then which markets are actually available to you? Practically high growth markets are only 2, India and China. Europe is also stagnated. A lot of other markets are also stagnated. India and China is where the growth story is there. So world over, people wants to come to Indian market. That has also led to a lot of healthy balance sheets, as he said. A lot of companies which we see, be it Zydus, Torrent, Astral, they are sitting on a lot of cash because, year on year, in last 10 years, they have done excellent business. And slowly that business has meant a lot of revenue generation and a lot of money for the company. Slowly they have reduced their debt also, and they are sitting on cash. And when you are sitting on cash, what do? You have to grow. Every company has to grow. So there are 2 ways. One is organic grow, and second is inorganic grow. If you are sitting on cash, and when your option is either you build something, you give a lot of effort, build a new vertical in 5 years, or you already have cash on your hand and you can just go on and acquire that vertical. So it makes a lot of sense for companies to go and acquire some other good company. And those kind of opportunities keep on coming. So Healthy companies are there, and there are a lot of targets, so we'll go and acquire targets. And that's how the M&A story is growing very quickly. Other reasons for M&A to grow, yeah, so this is a, so he already gave certain numbers, but this is Grant Thornton's statistics on M&A deals of last 5 years. So we can see roughly 400 to 500 deals are happening every year in last 5 years in India. Okay, this is Indian statistics. If you see 2022, then there was a deal of HDFC Bank of $40 billion. Then you have L&T and Mindtree deal, which is almost around $18 billion. Right? Adani Ambuja Cement is around $10 billion. So a lot of deals are happening. Apart from these very large deals, there are also MSME deals that are happening in the market. And most of us are professionals, so we can sometimes understand the rationale for those MSME deals also. There are companies who don't have succession planning, so they want to sell their business. Okay, the kids are in US, so they'll feel ke chalo, let's move out of business, let's sell it to someone else. There are companies who are having very good wealth base, and they want to grow now. They want to acquire certain companies. There are companies who feel that they are in a very traditional sort of business, like textile players, and they want to do something, dynamic. They want to diversify their line of business. They want to enter very dynamic sector like pharma, or they want to enter tech. So those companies are also into market for acquisitions. There are companies who, so there are all type of players are there. There are companies who wants to buy, there are companies who want to sell, and this is leading to growth in M&A activities year by year. Earlier, if you see our Gujarat market, very few promoters would actually consider going out and buying something, except the large corporates. But if you see after COVID, I've been able to witness that a lot of mid corporates also go out and buy companies. So case in point is our deal of Asahi Songwon's acquisition of Atlas Life Science. So Asahi Songwon, a 50-year-old group, they never considered acquiring any company. But at the end of the day, after COVID, they did acquire, they went out and acquired Atlas Life Science. They thought that our chemical business, we need to diversify, we need to do something similar, and they entered the pharma business. So these kind of deals in mid corporates are also happening, which is speaking a lot for us in the sense of the M&A opportunity is now real for all of us. It's not that M&As are, big hi-fi things, complex terms only happening with large corporates. M&As are now slowly happening in India in mid corporates also. These are the acquisitions. Apart from that, as far as we CAs are concerned, we can see a lot of internal restructurings also. Or if we are not able to see, then I am sure every one of us, we have certain groups where we can recommend internal restructuring to save, to make value for those groups. So these are also high value areas that we should look at. So first thing is the M&A. Second, generally when we speak about M&A, the very next sentence comes that M&As have been very difficult, right? M&As tend to lose values, and that research, and there is a lot of research to back that. More than half of the M&As fail, and people bring that up very quickly. So now, I would say that this research is generally from developed markets. US, Europe, they were the people who were doing M&As, and there a lot of M&As failed. So I would just cite one report on emerging markets. What is the M&A status in emerging markets? Okay. So this Professor Prashant Kale is a good faculty and I have studied with him. So he did his research and he found 2-3 things. One is that acquisitions in emerging market actually created positive values. In developed markets, the study was that, at a lot of times acquisitions lost value, So they were quite neutral in developed markets. But in emerging markets, the M&As created value. And he found 2-3 things. He said that in developed markets, organizational difficulty post-mergers were very high. Cultural issues were very strong. Second, whenever a company came out in US market, those companies used to find multiple bidders for the same company. And third is, since in US, Europe, developed markets, the companies are generally managed by professional managers. Those professional managers, they generally overestimated the value they can create by acquiring a company. While in India, or rather in all emerging markets, that is India, China, Brazil, the corporate control is still in infancy, right? So the professional has to do at times what the promoter is going to do. Lot of companies are still promoter driven. Second, when a company comes out for sale, those many bidders are just not there in India. Okay, there would be very few companies who will come out and bid for you. And third, there are a lot of small uncompetitive players with good products. Okay, so there are good companies, but not very competitively being run. So these kind of companies can be acquired at low valuation. So compared to developed markets, in emerging markets, actually you can acquire good companies at good value. That meant this three things. One is that acquisitions in emerging market generally created value. Second is MNCs which came into Indian market to acquire, they generally created lot more value, because they knew how the acquisition process is run, they knew the theory of acquisitions, and they knew how to make corrections. So MNCs were even more successful in acquisitions. And third thing is that related acquisitions were viewed more favorably. They created more value. So when we say related acquisitions, in support I would say, so there are one type of acquisitions where a textile company will go and buy a chemical company. And second is, if you heard Hiranand Bhai, so Hiranand Bhai is a very old friend, and he has said a lot of good things. When you go through his lecture, he said that they did a lot of diversification. He spoke about diversification. But he said one very critical thing, that all that diversification was related to buildings. Every acquisition they went and did, it was related to building, in the sense it was either pipes, it was either adhesives. Adhesives are used in pipes, right? It was either paint, right? So somewhere down the line, they were doing related acquisitions. And related acquisitions create a lot of value for the companies as opposed to unrelated acquisitions. So point of this slide is that M&A in India or any other emerging market is in general likely to create a lot of value for the acquirer. In developed markets, it creates a lot of value for the target, but in our market, it may create a lot of value for the acquirer. So this is the base. Now we'll slightly go towards the process. Now I'm running all of you through the process just for the idea of it. If you have any questions, feel free to ask. This session is supposed to be interactive. If you ask questions, maybe we'll have more fun. I'll run you through the process, the objectives of M&A, and then we'll see one or two case studies. And in that case studies, we'll see what everyone thinks and how relevant that is. Excuse me. So this is the M&A process. If you see today's lecture, it is sort of designed based on this process. M&A is 4 main stages. One is the strategy phase, where someone will think about acquiring a company. He'll think what is his strategy, what type of company he should acquire, and whether he should acquire or not. Second is valuation and bidding phase. Once he identifies a target, the that target would then both buyer and seller would sit in a, they'll try to negotiate, they'll try to come up with a valuation, they'll try to come up with a structure. Third is the legal process, where generally without us that legal process cannot go through. And fourth is the integration phase, which again is very important. So I'll start one by one. In strategy phase, first thing is strategy alignment. What we have to understand is that M&A is a tool for any company. M&A is not a strategy. Okay, no company can say that, our strategy is to just go in the market and acquire different companies. That cannot be the strategy. Any company has to first decide what it wants to do. Okay. Anyone who is interested in the strategy part, there is a book, there's a authority is Michael Porter, who has written a book, Competitive Strategy. Every company has to first decide what it wants to do. Okay, there are different strategies. Broadly, we can say there are two main strategies. One is the differentiation and one is cost leadership. And the company will need a proper vision that, what it wants to achieve in next 10 to 15 years. And once it decides on that strategy part, then it has to come back and decide, how it will achieve that, whether it will grow organically or whether, acquisition makes sense. And if it decides, that for us, acquisition makes sense, then he'll try to find targets in the market. Okay, that what kind of company can we acquire who will help us in achieving that particular vision. So example already given is Pidilite. Pidilite is already, they are very clear that we want to be in this particular line, and we will buy out our opposition, our competitors, for two things. One is those products we can sell in our network, and so that is inorganic growth for them, and that is also killing the competition. So that is the target selection. And third, most important, is the assessment of value creation. You cannot just go out and buy something. You have to first identify that if you buy it, then what is going to happen? How much value can you create by acquiring a certain company? So the buzzword is synergies. Okay, you have to think in terms of synergy, that how much synergy can you generate if you acquire a target. Synergy is the starting point of M&A, so we'll take it in more detail. Right now, I'll just run you through the entire process, and then my lecture would be on the first part, okay, the strategy phase. We have a lecture. So next phase is valuation and bidding. So in valuation and bidding, once you identify a particular company, then you will try to negotiate with them on different parameters. Okay. First one is valuation. We know valuation. I think now valuation has been a key word in last 3-4 years. We know there are three main methods. It is DCF, then relative valuation, asset method. And we'll try to come up with a number, okay, with some base that, by DCF, this kind of valuation is coming. In M&A, relative valuation also is very important. It's very important at, comparable, what is happening in the comparable companies, Suppose, if you are going to acquire a paint company, then what is happening in other paint companies. What are the last 4 or 5 transactions that have happened in paint? Okay, and what are the corporate players, listed companies, what kind of valuation the listed players are realizing in paint. So relative valuation is very important in M&A in valuation. And third is the asset method, which may make sense at times. So you'll try to come up with a valuation number. Your target would be having a valuation number with them, or if you are target, then your buyer would offer you a valuation number, and there would be a lot of discussion. Next is negotiations. So negotiation would be on valuation, negotiation would be on the structure. Not all deals are upfront cash. So you have an option, if you are a listed player like Astral can also offer stock to the target. Okay, so how much would be cash? How much would be stock? Would all payment be upfront, or would payment be in phase wise? Right now, if you see all the deals, generally they are phase wise payments, right? Promoter, the selling company may ask something upfront, more upfront. There are many other points which Hiranand Savlani Sahib discussed indirectly. So what would be the compensation of promoters post-merger? Who would be the key personnel, whether they would be staying with the company, they would be leaving, which assets would be included or excluded, what would be future warranties if the certain benchmark profit is not achieved, then what? So this kind of points, there are so many points. There could be in any specific deal at least 20 or 25 points would be open to negotiations, right? You'll as a banker, our job is to identify the key points, which will make or break the deal, and there would be many other points also. So a lot of negotiation would take place. Once negotiation has gone through, then the transaction structure part would come. Transaction structure is again a very complex subject. I'll try to simplify it, right? There are three major parts of transaction structure. One is the commercial considerations, second is the regulatory considerations, and third is the tax considerations. So I'll start with tax. For us, it's very easy to understand, whether a transaction would be a merger or a slump sale, right? Such kind of points would start the negotiation, right? Same, and that would have a lot of impact on the tax part also. That would have a lot of impact on how fast the merger goes or how slow it goes, whether there would be any future liabilities from income tax side or any other side. So these kind of things will come in the transaction structure. Once these three things, and both buyer and seller are on same page, then the due diligence will start. So now our second lecture is on due diligence, and third lecture is on transaction structure. So this two part, and then once this due diligence is done and transaction structure is finalized, then the term sheet would be given. The buyer would give a binding term sheet to the seller, where all the terms would be in writing. Seller will accept it, and then that term sheet, generally it can be a draft term sheet or binding term sheet. Then the due diligence may or may not have happened at that time, and once DD is also over, it would be a binding term sheet where both parties cannot back out. Once the term sheet is signed, the legal advisors would take over. They'll put up the scheme of arrangement in the NCLT, or they'll appraise the stock exchanges, they'll take the board approvals, they'll take the shareholder approvals, and they'll try to finish the transaction. So it will include all the necessary formalities, and basically 4 to 6 months or 7 months would be required to finish the transaction. So our session 2 is on due diligence, session 3 is on transaction structure. So that is the second and third phase. And now fourth phase, which is often overlooked, surprisingly, in MSME clients at least, is the integration phase. As Hiranand Bhai also said, it's not over. If you are going and buying a company, you are just paying cash and company is yours. But then the actual hard work starts, for the buyer at least. He has to make sure that particular company is first sustaining its operations, and second, you have some value proposition when you bought that company. So you are able to realize all that value proposition. So for that, a proper integration process has to be done. Okay. There are many focus areas in this integration process. First of all, the buyer needs to have a clear vision for the company he is buying. Okay. He'll need a proper team who will drive the integration process. He'll have to design a proper organization, right? We just heard that a vice president in a smaller company would be competing with a GM at your company now. So you'll have to make sure that your organizational structure is fair and is able to take care of such issues. Cultural issues, again, a lot of cultural issues will come up. People often get very used to doing things in a certain fashion, all right, because they know that this particular thing has worked in past. So you'll have to make sure that both organizations, their culture has to somehow match. Certain companies, when they buy a smaller player, you buy a smaller player because they are very agile, right? When IBM makes an acquisition, IBM is like an elephant. It's supposed to be very slow, very process driven, right? But the acquisition that it makes is probably going to be a very small player would be very agile, you know, very startup driven culture. So you have to make sure that somewhere you match, you know. IBM will have an excellent sales team, right? While your startup probably would be very good at designing and offering a product. So you have to match those two things. So that cultural integration is very critical. And generally, M&As fail, you know, half of the M&As that fail are generally, the reason cited is the integration process, okay? The cultures didn't match. You know, it's very simple to say the cultures didn't match, but basically the integration process was not properly carried on, and, you know, the synergies were never realized, and the acquisition didn't make sense at the end of the day. And again, last part, the assessment. You have acquired a company, right? You have integrated the company. Now, after a year or two, you have to understand that how much value did actually get created in that acquisition. You know, whether it was a successful acquisition or not, right? Generally, the M&A game is won by MNCs, okay? In that study also I have written that. Because MNCs keep on acquiring companies. There are instances like IBM, Cisco, who have made, you know, 50 acquisitions, 70 acquisitions. What they do is they acquire a company, they have a set process. They'll find out, you know, whether that acquisition made sense or not. And when they go for the next acquisition, they'll have few learnings from the previous acquisitions. And these are the players, that is Cisco, IBM, who are the most successful acquirers, right? So in our clients also, you know, ideally, so clients like to, you know, make big acquisitions. You know, a 500 crore turnover company would like to acquire a 200 crore turnover company, right? They'll not like to acquire 15 crore turnover companies. It's very difficult to manage 15 crore turnover companies. But if we have our way, ideally we would suggest, you know, to acquire every year rather than make one big acquisitions. If you make one big acquisition, the skeletons are going to be there, you know. There are going to be surprises which will come up later on. But if you know your process, if you are a serial acquirer, then you are bound to create a lot of value eventually. So this is the process. Any doubt till now? So as I said, my job is to take you to the first phase, and second and third we have session 2 and 3, and fourth is taken by the industry people. Well, we'll try to understand the last phase as well.
So,
Yeah.
So can you tell me something which this Hiranand ji said talking about insurance.
Hmm.
So whether insurance is available in Indian market?
No, even I have never heard about it. But we have something close to insurance, you know, structuring, right? But I am not very sure about insurance, whether it is available or not. Even first time I also heard it. I'll definitely check it. Yeah. So I'll go everything in detail, but yeah, you can ask a question.
So what sort of insurance?
No, I don't know. I don't know. I have no idea. I have never heard insurance in M&A. But yeah, insurance companies are also smart. They also come up with new products. So yeah. Sorry? Yeah, so that is part of structuring, right? Warranties, indemnity, right? Why a lot of structured deals are happening? You know, they'll not pay everything in first year. They'll pay everything in second, you know, they'll pay a chunk in first year, then second year some part, third year some part, fourth year some part, to make, you know, to make sure that the other management is also involved, and, you know, no surprises are taken care. I think we have 15 minutes for question answers, but before that I would like to go on certain aspects in detail. So M&A starts with synergies, okay? Any acquisition has to be synergetic. This is the rule of thumb. Okay? It may be difficult for us to understand at times that, you know, how synergies come into picture. But if there are no synergies, then there are chances that that acquisition will not realize the value. And what is synergies? In very simple terms, it's 2 plus 2 is 5. Okay. When you buy something, synergy means that the combined entity has more value. There is a meaning of synergy. So value, so let's say there is a company with market cap of 1,000 crores and there is which is acquiring a company with market cap of 500 crores. Then ideally, before even the legal process starts, the acquisition should result where the resulting entity is having market cap of at least 1,700 crores. Okay. Now what is synergies? What type of synergies are there? So there are basically two type of synergies. One is operational and one is financial. Operational synergies are mainly of two types, revenue and cost. So when we say revenue synergies, that means the target company is either having new products or better quality products, or they are having maybe better distribution channels. You have good products and your target has better distribution channels. So one of our clients, he is having excellent products, but he is having limited reach as far as the entire India is concerned. So they are contemplating a target who is very good in distribution, who has no product of its own, who has excellent distribution network, has presence in all states of India. So this is the kind of revenue synergies we are looking at. So when Astral said, that their first acquisition, which I was also, a part in limited capacity as a banker, their first acquisition, Resinova, they acquired a adhesives company because pipes and adhesives, they go together. So basically they are increasing their product portfolio. And that is why that acquisition actually made sense later on. That company actually grew. In revenue synergies, we are also probably looking at a lot of cross-selling. One good example is reverse merger of ICICI Bank and ICICI. So ICICI, for the people who are very senior, used to be a cornerstone of Indian economy, right? And then the ICICI Bank came. Now ICICI as a development financial institution had very strong corporate relationships and excellent manpower. Since it was a very key organization, a lot of smart people went into ICICI Limited. And the other was ICICI Bank. The bank has a very, by nature of bank, you have a lot of cheap deposits at your disposal, right? You have a lot of capital, which is very cheap. You are paying 3-4% to your saving account holders. While the other company has a lot of smart people, So this merger basically created a lot of revenue synergies because now a lot of smart people with a lot of fancy products had access to cheap capital. So they can move out and you do a lot of cross sales. So this is an example of revenue synergies. Second is cost synergies. You decrease your cost of goods sold. Let's say two companies are acquired, right? Both are having two CFOs. Now practically only one CFO is required at the end of the day. So there are going to be a lot of layoffs. That layoffs will create issues, because people don't like to being laid off. People would be very uncomfortable, whenever a company is acquired. But that is what happens in certain industries at least. Let's say example is steel. In steel, if an acquisition happens, then definitely steel is all about cost leadership and there'll be a lot of layoffs, and a lot of money would be realized. Second example is similar oil industry. So in 90s, the landmark merger of Exxon and Mobil happened. Exxon and Mobil were two very large oil players. Okay. One of the main reasons for proposing this merger was cost synergies. So when at the time of merger, they thought that around $2.8 billion of cost is going to be saved. But when the merger got over, they actually ended up saving more than $4 billion. It was a very, very, very successful merger. The market cap was in favor of it. The combined entity was extremely large, very powerful, and slowly, in fact, it was so successful that a lot of other companies also in oil, they also merged afterwards. Third is reduction of agency cost. So companies in Gujarat, we are somehow, we are accustomed to look at companies driven by promoters, but that is not always the case. Generally, companies are driven by professional managers. Professional managers have different set of interests than the owners. If a professional, given a choice, He would like to make profit in next 2-3 years rather than wait for profit at the end of 10-12 years, right? Am I making sense? They'll not think very long term. Professional managers, are salaries and bonuses are linked with what you are doing this year. Okay, what is the profit number in current year? So this leads to a problem called agency problem. The people who are managing the company are not very good at managing it because their interest levels are different. So in one of our clients, the target that we were looking at, that particular target was managed by a person who was holding only 5% of the company. Okay, and the promoter group 60% was practically not involved in day-to-day of that management. And that company tanked actually. So our buyer was contemplating buying that. So that is the agency cost. You buy such a company and you make suitable adjustments. You take care of the management and you realize a lot of energies. The resultant company is going to be much more efficient. Second example that comes to mind is takeovers by PE players. So KKR purchased Toys R Us because Toys R Us was making losses. It was not properly, efficiently run. So private equity player will come and buy the company entirely. Yeah, any doubts in this? This is very important. We'll see how in case studies also this makes a lot of sense. But yeah, this is one of the main reason of M&A. Okay, from our point of view, as a professionals, we have to understand that this is one of the main objectives of M&A. And second is of more interest towards the financial synergies. First is debt capacity. Okay, rather in our Indian case, often the buying company is sitting on a lot of cash. Okay, that means they have no debt in their balance sheet. And what does debt mean? When you have debt on your balance sheet, you have a lot of tax advantage. Right? Am I making sense? Because debt is at the end of the day, you'll start saving straight away 25-30% on your tax, right? So a buying company may consider a target which has a lot of debt, So this happened. So one of the example is Alembic Dabur merger. Alembic was practically debt-free company, while Dabur was having a lot of debt on their books, right? And Alembic also, when they acquired Dabur, they were able to pick a lot of debt. Rather than raising any further equity, they picked debt and did the transaction. That meant that after the merger, for a lot of years, Alembic's tax liability was reduced. And they were actually, so that means more money for you, right? More money for the company. So this is an example of financial synergy. Second, I hope most of us have seen this kind of merger, that is the tax loss carry forward. You buy a company which has a lot of taxes, right? You acquire it, you merge it, and you enjoy those losses for 7-8 years, and you are able to reduce your tax liability. Third is the cash starved firms as target. So this happens especially in the startup boom that is happening right now. A lot of startups are there who are very agile, who are very outgoing, who come across a lot of opportunities. But since startups don't have access to a lot of financial muscle, they are not able to use those opportunities. They are not able to enjoy those opportunities. A financially strong player who will acquire this startup, and then those positive NPV projects can be taken care of. So, and this is especially true right now. If you see last 6 months, it's called startup funding winter. If some of you are aware about that term, the startups are practically private equity and VC funds are not putting a lot of money in startups right now. There is this last 6 months, the liquidity has dried. After COVID, that abundance of money, there was overflowing basically. You want money and you will get it. That has stopped right now. So at such times, when startups don't have access to their own funds, some financially strong player can come and realize synergies. And the last is synergies from reduction in systematic risk. the example I'll give you is IDFC and Capital First. So IDFC, if people know IDFC Bank, they generally had a very strong corporate book. Okay. In banking, there are two main types of business. One is the corporate book, one is the retail book. So IDFC had a very strong corporate book, but that is very risky also at times. एक भी corporate, if he is in trouble, even a single corporate, and suddenly your whole year's profits are gone, right? So that's a very risky business to be in. Okay. The second example I would give you is Lakshmi Vilas Bank. They were also a very corporate oriented book, and they actually went bust, right? So IDFC was having a very strong corporate book, and at the other way, the acquirer, Capital First, was having purely retail book, okay, not a single corporate account. So Capital First acquired IDFC. So IDFC's corporate risk was basically taken over. If IDFC standalone, one bad year and it is in losses, but because of Capital First stable portfolio, this acquisition basically reduced the systematic risk, of this particular business. So that is a synergy from reduction in business risk. This is the theoretical aspect, but actually if you analyze any successful deal, then you will be able to find one of these reasons, and you will be able to understand that why that particular deal is successful. But to simplify this, I'll start another way. Okay, there is a study by McKinsey, okay, which they tried to find out that which acquisition deals were successful. Okay, what kind of strategies when taken by acquirers were successful and what were very difficult, what were not very successful strategies. Okay, so these are also basically objectives of acquisitions, right? But this is not the theoretical part. This is practically, what happened and then what, whether it was successful or not. So they came up with 5 strategies which are generally successful, which led to successful acquisitions. First one is consolidation to remove excess capacity. So the example is again Pidilite. Okay, what Pidilite did, it acquired 20-25 competitors slowly. Those competitors were eating the market share. Okay, they acquired them and they consolidated. Pidilite is very successful, no doubt about it, right? So it's a successful strategy, right? Second example is if you see Zomato, they acquired Uber Eats. Okay, Zomato, Swiggy, and Uber Eats. It's a 3-pitched battle. Zomato acquired Uber Eats, so basically it meant now there are only 2 players, and your chances of success increases, which Zomato did actually became successful afterwards. But there's a similar strategy. Second is, which is a favorite of MNCs, get skills or technology faster or at a lower cost than they can be built. Example is Apple's acquisition of Siri. Okay, Apple has a lot of resources at its disposal. It could have easily, invested maybe $100 million and made a software. They are also very good in making softwares. But a Siri assistant, AI assistant is available in the market. You can buy it in suppose $120 million. Then why do you want to, wait for 2 years, spend $100 million, take the risk, that cost may actually shoot up to $150 million. You don't know. So simple. Apple just went out, bought Siri, right? Integrated it with its own platform, and it's good to go, right? So in tech companies, this is one of the most successful strategy, and it's a very easy on how we can make deals, in this particular fashion. Third is again, generally seen as very successful is improve target company's performance. We see a lot of private equity funds who go out and buy a company. The objective is that once you buy that company, it's you'll make certain changes, you'll put up a professional management team, and you expect that that particular company's performance will go up, right? Which generally does also, because this PE funds professional teams are very ruthless. They'll cut all the flabby parts of a company. They'll very efficiently control costs, and generally they'll make sure that the client stays, client's performance comes, and which does happen. Fourth is pick winners early and help them develop their business. So the classic example is Facebook's acquisition of WhatsApp. WhatsApp had no revenues, but everyone knew that WhatsApp is the thing, and maybe in future it can be commercialized. So Facebook went on, they paid big bucks and acquired WhatsApp. Classic example, Cisco. Cisco has made 70 acquisitions till date. Okay, 70 acquisition, what kind of resources you need for 70 acquisitions, but they have done it in very successful company. Flipkart acquired Myntra. When they acquired Myntra, it was only for 2,000 crores. And look at the Myntra right now. Because of Myntra, Flipkart is the fashion leader in this industry. So, a successful strategy. Fifth is accelerate market access for targets product. This has been done by IBM. IBM buys a lot of companies. They have in fact made 43 acquisitions with a simple strategy that they should have good products. IBM has excellent sales team across the world. Okay, and those good products are pushed through their sales team, and a lot of value is being realized. Then these are 4 strategies which are generally not very successful. First one is roll up. Consolidating in a highly fragmented industry. Example. So these are all examples. They are not general rules, but these are all examples. So one example is the Go mechanic. Okay, mechanic industry is highly fragmented. You'll find mechanics at every nook and corner. So Go mechanic tried to consolidate it failed somehow. So this is very difficult in a highly fragmented small business type of market. Second is consolidate to improve competition behavior. A lot of steel companies. So ArcelorMittal case is one of the example. They thought that we'll merge 2 largest company of steel, will make a huge machinery with 10% of global capacity, and then we will have very good negotiation power with the automobile companies. There are a lot of automobile companies who buy steel, right? That is the main buyer. But they could not. They, even after having 10% of the global capacity, they couldn't do it. So this is one of the very difficult strategies to execute. Then third is enter into a transformational merger. So Royal Dutch Shell and BP are right now trying to do it. They are basically oil companies. Oil companies are not environmentally positive in any case, but they are trying to acquire a lot of renewable power companies to become carbon free. Very difficult. They're trying to pull it off. Let's see. And fourth one, which is the, which everyone likes, all of our clients, buy cheap. Okay. But generally it has been seen that this is one of the most difficult strategies to pull, because there are no strategies in this, right? You have come across an asset which is available for lower valuation or cheap. So it is generally said that you buy cheap and you buy twice. So this is the objective we can understand. So first I'll run through the buy side perspective, because we also heard a few things about it. Buy side is very difficult to, so buy side means a company with a lot of financial muscle is going to acquire something. Okay. It is generally 2 things about buy side. One is that, so there is an old saying, it says that the buyer needs 100 eyes and seller not 1. Okay. You'll have 5, 15, 20 companies coming at you. You'll have to be very clear on what you want to buy, how you want to buy. No matter how diligent you are going to find surprises afterwards. So there are certain, from buy side, there are certain tips, on how to see it properly. One is you have to first understand the motive of sales side. Why the sales side, the target wants to go out of the business. One example that comes to mind is De Beers. We have all heard the saying, diamonds are forever. Okay. So that is the tagline of De Beers. It is the most successful player in the diamond business from last 80 years. Now, De Beers sold its business in 2010s. Okay. It had a lot of things going for him, De Beers. Right? They had a monopoly from 80 years. They actually control the mines from where diamonds are pulled out. Right? And De Beers business was bought by, I think, a Russian group. Now, after the business was brought, in 4 or 5 years, the performance went away. Okay. For 80 years, this group was solid. it was having a monopolistic position in the market. But then somehow in 5 years it went away. So what happened was there were two things that De Beers could see, which the buyers couldn't see. De Beers found out that there are new diamond mines which are available. In African countries, new diamond mines are coming up. So the De Beers monopoly on diamond mines is now no longer true. Second, they found out, so not found out, but second, everyone knew that, natural diamonds, they are also having their mark on the market. Natural diamonds are as good as artificial diamonds, they started becoming a big thing. So they are as good as natural diamonds, there is no blood on artificial diamonds. And because of these two factors, the diamond business is not going to be, enjoying the monopoly that it has enjoyed from 80 years. So buyer has to be very clear, why the target wants to move out. Okay, it has to do its due diligence very properly. It has to meet him, at least 5 to 6 times to understand, what he is thinking, what he sees in next 10 years. One is fundraising for the deal. M&A deals are not supported by banks. You cannot buy shares with bank funding, as simple, right? So you have to make sure that your fundraising is through, it's properly structured. There are different ways of raising those same funds, which we have been doing that, right? But straight away it's not allowed. So you have to make sure that your structure is in place, Second, you also have to be sure that, there could be some positive or negative surprises in the future. So you have to keep having, that kind of excess financial capacity to, if any shock comes, then it's not there with you. Fifth is investment in integration. Integration process is often overlooked by a lot of players. So it has to be properly managed. And so these are the buy side perspective which we have already heard. Second is sales side perspective. So as an investment banker, or when we are representing our client, for any of you, when we sell a company to someone else, then what should be the process? So first, before we even initiate the process, you have to make sure that target company is ready. There is M&A readiness. Thorough preparation is done before launching the deal. Hiranand Bhai said that, the merchant bankers, from 2 years they are trying to, what we call, window dress the company. Well, we don't want to window dress, but at least we have to make sure that that company is ready for due diligence, that company has a proper strategy. A lot of companies, they just run like that. They have no strategy, no vision for the target company. So at least, you have to sit with the promoters of the seller company. You have to understand what is their vision. That vision should be properly out for the buyer, that buyer should understand what is the vision, and it is banker's job, it is our job to make sure that, that vision fits in buyer's vision. Buyer is not going to just go out and acquire something. So we have to make sure that this seller company's vision and buyer company's vision, that matches. So that is a part of M&A readiness. Second is upfront disclosures. There is no sense if, something comes up in due diligence. That is just going to spoil the deal, right? Whatever is there in the company, we have to understand it. Even, promoters may not say that also openly to us, but we are meeting that promoter from 3 months, 6 months. We have to understand what they are trying, what they are speaking, what they are not speaking, and all the disclosure should be there when we pitch the deal to someone. Any disclosures afterwards is going to spoil the deal, and it will leave bad taste in the mouth. Third is, once you understand that this company is ready, now you reach out to buyers, right? As I said, you have to check the fit, whether this company actually makes sense for the target. If you reach out to, 100 people and it doesn't make sense to 95, then that deal is never going to happen. You are just running here and there. There is no deal, right? So you have to meet maybe 5-10 people, but those are the proper 5-10 people who for whom buying our company makes sense. So you have to think in terms of the target, and even your valuation has to be in such that you will understand that if that target company is buying our company, then what is going to be the combined entity's worth. Based on that, you will be entering into valuations, negotiations, and based on that, you will be talking. Not just like that, this is my company, you know, abhi kya karna hai. So that doesn't work. It doesn't, you know, deal nahi hota usse. And last is, once you launch a deal, you have to go for closure. Okay, a lot of time what happens is, we will have something on our hand, you know, half cooked लेके market में पहुंच गए, मिले 10 लोगों को मिले, 15 लोगों को मिले, 3 months, 6 months gone, 9 months and you have no motivation to, you know, take that deal anywhere. And then that deal is tainted. That deal is never happening. मतलब होगा तो कैसे होगा, as you know, someone say, as Hiranand bhai said, 30% discount, 50% discount. मतलब basically distress value पे deal होगा. The example is Lakshmi Vilas Bank. So Lakshmi Vilas Bank had a corporate book. They took the risk, went bust. Okay, many of the corporates, they actually, you know, they went into stress, and the bank came into stress. Then for 2 years they were trying to find the buyer. Doesn't work like that. Okay. And after 2 years, basically RBI intervened. They fired all the management, and they merged it compulsorily with DBS. And the shareholders, equity shareholder value क्या कर दिया? Anyone knows? 0. खत्म. That's it. So no point of, you know, better you wait for 3 months, 6 months, you are ready with your deal, then you take out to proper relevant people where you understand that something is going to click, you know, some sense is there. You tell them upfront कि भाई इसमें ये issue है, ये अच्छा है, you know, these are the points on which you can consider buying it, and then you go for the closure. So this is the sales side perspective. Buy side perspective में we hear a lot that, you know, things don't work out, you know, M&As fail, the surprises do come. Then what is the way to minimize those surprises? So we have already discussed that. Yeah, so now so surprises do come and M&As do fail. So it's called winner's curse. You know, you bought a company, you won, you know, you won the bidding, and then you lost because your market value is going down, right? Why that happens? One is professional managers, they always tend to overestimate synergies. ये ले लेके तो ऐसा हो जाएगा, you know. That's it. मतलब इतना तो कर ही देंगे अपन. You know, people have a lot of trust on their own abilities. You know, कि इतना, when we buy this company, we'll be able to cut cost by 5%. मतलब it's very easy. अपने कर लेंगे उसको, right? So they tend to overestimate synergies. Second, managers' incentives are also linked with the deals. In the sense, a buyer company CFO, if he is running a 20,000 crore market cap company, and if he is running a 35,000 crore market cap company, his incentives would be different, right? So he has incentive to go and acquire, you know. Empire building comes very naturally. All promoters think कि चलो अपना company का size double हो जाएगा, right? And as we heard, which is true, promoter बोलेगा company लेना है, तो then there is no one who can say anything about it, right? Example is Mittal. Mittal wanted to go and buy Arcelor. उसके mind में set हो गया. I want to buy this company. So our second case study was actually ArcelorMittal. I think because of time, probably I might not be able to give justice to it. So I'll say some of the insights. So one, LL Mittal decided that I want to make the largest steel company in the world. That's it. He went for it. He paid 80% premium to Arcelor on the share price, on market cap, not on DCF valuation. On its market price, he ended up paying 80% valuation, right? And then ArcelorMittal failed. I don't know how it came. No surprises. It failed big time. You know, in third year, it was in losses. The largest company in the steel was in losses in third year. So, second is rosy projections. That also Hiranand Bhai said, you know, any projections that will come, extremely aggressive. So you will have to, you know, from seller side, you have to make sure that the projections are not, you know, on the sky. That is one thing. And from buyer side, you have to make sure you have to give proper adjustments to those projections to make sure what is going to actually happen, and not, you know, story which is, you know, fantasy. And third is the cultural issues. So these are the three issues why M&A fail. And now what can you do? First is you have to make sure that the target is a clear fit for your company, Okay, target is cheap, matlab doesn't mean that you go and buy it. Second is go after credible sources of synergies. Synergies ऐसे नहीं कि भाई 5% कॉस्ट कम हो जाएगा, ऐसा नहीं. You have to actually sit and you have to maybe bifurcate that 5% that क्या क्या होने वाला है उसमें. Be thorough with the due diligence. Due diligence is one of the most important aspect of the deal. We have an entire session, so I'll not go deeper into that. Structure your deal. Doesn't make sense that you pay 100 rupees on day one. Okay, pay maybe 60 rupees, 70 rupees on day one, 15 rupees for next 2 years. Structure your deal so your incoming management is incentivized to stay with you, incentivized to run your company, their key personnel are going to stay. So that is part of structuring, which would again be covered in transaction structuring, but very important. Begin thinking about integration before thinking about valuations, right? And post-deal assessment. So I'll start with the case study that we have. So Walmart acquired Flipkart, right? We all know that. So in 2018, the Flipkart was owned by SoftBank 22%, Tiger Global, and Walmart came and acquired in 2018. They did the 77% stake acquired for $16 billion and at the valuation of $21 billion. What is Walmart? I think we all know that Walmart is the largest retailer of US. Okay, it is so big that it has actually captured the entire US market. Okay, US market is saturated for Walmart. Then once it won the US market, it thought that now, and it became listed in 90s. So it thought, being a listed company, you have to grow. So what are the next growth avenues? So it went out. One is the Chinese market. It acquired JD.com. And it entered Indian market also. In 2007, it did JV with Bharti. Opened its first store in 2009. It built up 20 stores. In 2013, the relationship went sour. Okay, and then from 2014, Walmart was on its own in India with 26 stores, but a very small player at the end of the day. Flipkart, on the other hand, is the Indian success story. 2007, it launched. It made 5-6 very interesting acquisitions like Jabong, then Myntra. It was number one in fashion category and mobile categories in 2018 when this acquisition happened, when Walmart Flipkart acquisition happened. Right? In market share wise also, it was a number one player in India. These are the details of fundraise, right? Now, why this chart is there? Interesting part is, if you see 2014, the valuation is $11 billion. 2015, the valuation is $15.5 billion. And in 2017, it is again $11 billion. Right? In 2016, 2017, Flipkart was in troubles. We know the Indian e-commerce models, right? You heavily discount the final product and you are constantly burning money. Flipkart, Amazon, everyone was doing that, Snapdeal also, and that created a lot of issues in 2016. So in 2016, what happened? The PE players took over the management of Flipkart. That is, Tiger Global came and he took the management of Flipkart. Okay, one of the ex-director of Tiger Global came. And then finally, in 2017, they brought SoftBank. Now, this was the Indian retail industry at that time. It was the 5th largest market. Till FY18, the growth was there, but from 18 to 23, so next decade, 18 to 28 was supposed to be super aggressive growth rates. These were the players at that time, Snapdeal, then 91 Mobile, India Mart, Amazon. And in this, Flipkart was there, leaders on one of the 4, in these 4 categories, Flipkart was at either number 1, number 2. In fashions and mobile, it was number 1. Electronic and FMCG, it was, I think, number 2 at that time. Okay, so now the interactive part. Walmart did acquire Flipkart, so no doubts about that. But my question would be that why did Walmart acquire Flipkart? Anyone would like to, give their thoughts? Ready-made platform, okay. Right.
Walmart had already they failed in acquiring Amazon over there or setting up a joint venture with Amazon.
Hmm.
In a way, they took it to heart that we need to enter, if not the biggest market, at least biggest or second biggest in terms of the population or the demographics to offer.
Yeah. Yep. Very sensible. Yes. Then. So one is
Government resistance was almost negated because of Flipkart.
yeah, excellent. So before earlier it could not acquire, but yeah, from 2016, 2017 the regulations allowed it to acquire for the first time. Yeah. Good. So we saw, a lot of objectives and why a particular company would go and acquire the other company. We thought about a lot of things we saw. What else comes to mind?
Number of customers available with Flipkart.
True, both true. Yeah. So once you acquire, you straight away have access to a lot of customers and customer insights as well.
Cost of acquisition is saved.
Cost of acquisition? No. So that is the second question. A lot of people thought that this deal was very expensive. So it was not a cheap deal, right? We'll not go into numbers because we are running out of time. But we can take for granted it was a very expensive deal. So why pay that much? If you spend $18 billion, you can make any kind of business. But still, they went for acquisition. Okay. So let us try to think this term, in a structure. First is the market. First question is whether Walmart wants to enter Indian market, right? So we saw that Indian market is very high growth market. 21st century is probably of India. I don't think anyone here would be able to doubt that. And I think globally also very few people would doubt that, 21st century is of India. So, and as you said, they tried to enter the market, burned their hands, they failed to make any proper business. So now the option is you again keep on trying, right, and become a small player, or you acquire a larger player. Money is not an issue for Walmart. Okay, that's a given. He is the largest retailer. So he is very right. So since you have burnt your hands, let us think in terms of inorganic growth. And so this logics, this you'll see in a lot of acquisition, Indian acquisitions also, larger acquisitions, same kind of logic you'll see flowing. Okay, once you try to go in detail. So now second question is why Flipkart? There are smaller players also, right? So second question would be from my side that why did they acquire Flipkart?
To avoid competition.
Right, to avoid competition. So Flipkart was the leader in fashion and mobile segment. We saw that in the slide. And second is India became a two-horse race. Okay, there were only two major players, Flipkart and Amazon. Third one, Snapdeal, was basically withering out. Right now I don't think it's a considerable player now. So, and this is very much like the US market, as someone pointed out, where only two horses, Amazon and Walmart, are there. For them, so it would be a similar sort of structure, so it made sense for them to acquire Flipkart. So they wanted to enter Indian market. If they want to enter, then Flipkart acquisition makes sense. Now again, we started the lecture stating that all acquisitions are supposed to be about synergies. So where are the synergies? All successful acquisitions are built through synergies, and any acquisition has to go through the synergy route, right? Where are the synergies in this deal? No one spoke anything about synergy when I asked the objectives. What do you think? What were the synergies in this deal? What is Walmart known for? Anyone from US? Consumer items, yeah. Anyone from US? What is Walmart? If you have to say one phrase. B2C. Everyday low prices. Walmart is known for everyday low prices. They have if you find lower prices elsewhere, we'll pay you the difference. So Walmart is the cost leader of US market, that we are the cheapest, right? So they must have thought that if we buy Flipkart, then we are going to be cost competitive in the retail segment also. They are already practically, they are the best as far as the supply chains go. They are best as far as the negotiations go when they source the products, right? Right? So they must have thought that if we acquire this, then in long term, on sustainable basis, we would be able to add lot of value on the cost part. And finally, a lot of analysts came up at that time, and they said that Walmart overpaid for the deal. So right now, and it does make sense because those deals were counted on this gross merchandise value. They were nowhere looking at the profits, EBITDA were practically not there, and still they were paying $20 billion, right? So they did overpay. And why did they overpay? Any arguments from your side? Synergies, of course. Then?
Entering into the retail market because I think there were some restrictions on the retail market entrance.
They were there. So he already said that when the deal happened, those restrictions were going away, right? So earlier they could not acquire, but now they could acquire. The question is now, why did they overpay for the acquisition? Flipkart in 2017, its sales went up by 30%, while its losses went up by 60%. It was already bleeding. Already it had taken up $7 billion, and those money was going very quickly. It was already in trouble in 2016, right? We saw that valuation hit also. Then for such a target, why overpay? So that is there, of course, users are there. So that is all part of synergies. No, the Amazon was not there, correct.
Somebody like that.
Yeah, but then why would even, how many players would be there who can pay $20 billion for a company?
For statutory benefits like the taxes.
No. No. We are CAs, but yeah, unfortunately. Enter into Indian market is given, that I started, India is a lucrative market. They wanted to enter. So yeah, those synergies are there. But the point was rather simple, that Flipkart was backed by Tiger Global and SoftBank. Flipkart was able to get SoftBank on its board. It's one of the largest funds. They were never going to run out of the money. They could have sustained themselves. So if they want to buy, either pay the price or just walk away. That's okay, right? So yeah. Yeah, seller is strong. So we saw that first why it entered, because it wanted to enter Indian market. Why Flipkart? So we understood why that Flipkart was one of the leaders in fashion, mobile. And fashion and mobile are categories where you can make actually lot of money. Fashion में कहीं पे एक shirt देख लिया Flipkart पे, it's very difficult to go and buy the same on Amazon. How can you search that shirt, right? So fashion is where margins are good. Mobile also people buy online. So why Flipkart was acquired? Third is, what are the synergies? We saw cost synergies are supposed to be there, and why overpay? And this is the assessment. Today, Flipkart is almost having 62% market share. Their recent valuation was close to, in 23, the Tiger Global got acquired. SL is a good, one of the partners is a good friend. They got acquired. And right now, the present valuation is $38 billion. So we can say in last 5 years that it was actually a successful acquisition. Then only this, they are now definitely the leader in this market. Right? All right. So I think I'll close in benefit of doubt. Yeah.
Thank you very much, CA Karan Vora, for discussing, mainly focusing on the synergies and the best example the Flipkart discussed in detail. He also focused on the M&A process and the operational synergies, the value you will get more if it is a related acquisition, and discuss both the side view, the buyer and the seller. So on behalf of the Ahmedabad branch of the ICAI, I thankful to CA Karan Vora for sparing the time and would like to see you in future. Thank you again.